All right, let's talk about a skill that really separates the pros from the amateurs when it comes to long-term investing, and that's performance monitoring. Now, this is not about gluing your eyes to the screen all day. No, no. This is about something way more powerful, disciplined oversight. So let's dive in.
You know that feeling, right? That crazy, frantic energy of the market, numbers flashing, news alerts popping up. It just sucks you right in. But what if the real secret to winning wasn't about moving faster, but about being smarter? See, the best investors get this. They actually deliberately pause. They step back from all that chaos to find a little clarity.
And that really gets to the heart of what I call the monitoring paradox. There is a massive difference between anxiously watching every single tick of the market and conducting calm, systematic oversight. One of them leads to stress and a ton of mistakes, and the other? Well, that one leads to confidence and much better results.
And look, this slide just lays it out perfectly. Every investor has to choose one of these two paths. Over on the left, you've got emotional screen watching. You know what that is. It's the path of anxiety, of overtrading, and it ultimately just torpedoes your own strategy. But on the right, you have systematic oversight. This is a planned, disciplined approach that keeps your long-term vision right where it should be, front and center. This is the million-dollar question, isn't it? It's the one that keeps so many of us glued to our phones. If watching every second is actually a bad thing, then what's the right balance? How do you stay informed without driving yourself completely nuts? Well, the answer is all about finding the right frequency. For most of us who are in it for the long haul, that means scheduling your reviews. Maybe it's once a week, maybe it's once a month. The really crucial part, though, is to let your system do the hard work. Set up alerts for key price levels or big news, and then give yourself permission to step away. That planned detachment, that's where real discipline starts. Okay, so effective monitoring isn't just one single activity. It's actually two. I want you to think about it like looking through two completely different lenses. One is pointed out at the market, and the other is pointed in at your own portfolio. So here's how those two lenses break down. Looking out, or market monitoring, that's your big picture view. What are the hedge funds doing? What are insiders buying? Then there's looking in, portfolio tracking. This is all about you, your gains and losses. Are your stocks actually beating the market? Are you maybe a little too heavy in one sector? You absolutely need both of these views to get the full story of where you stand.
Now here is a mindset shift that is just incredibly powerful. This is a real pro-level move, especially if you're the kind of investor who buys into a position over time. You have to stop looking at just your overall holding. The real story, the data you can actually use, is at the level of each individual transaction. So why does this matter so much? Well, think about it. Every single time you buy, you're creating a new cost basis. By tracking these little individual tranches, you can see exactly which buys are your superstars and which ones are dragging the whole position down. This gives you almost surgical precision when it's time to sell or rebalance your portfolio. It's a game changer.
Okay, so let's get real. You do this analysis and you find a dud, a stock that's just not pulling its weight. This is the moment where most investors get emotional, right? But we're not going to do that. We're going to use a clear, data-driven playbook instead.
And here it is, a simple four-step process that takes the emotion right out of the decision. Step 1, compare it to its benchmarks. Is it just having a bad day, or is it really lagging behind its peers and the whole market? If it is, move to step 2, set a timer. Put it on a short leash. Give it a specific time frame to turn things around, not forever. Third, while you're waiting, check out its competitors. Is there a stronger horse in the race you could switch to? And finally, step 4. If the data says that thesis is broken, it's time to replace it. No drama, no second guessing. Just a disciplined decision. All right, let's level up a bit. We're going to dive into some of the more advanced signals you can track. These are the kinds of details that professional investors watch to get a real edge by understanding what the market is really thinking.
Yeah, this is all about reading between the lines. For example, a stock with high short interest means a lot of people are betting against it, which, ironically, can sometimes set the stage for a massive buying frenzy called a short squeeze. Then you've got insider buying. When top executives are buying their own company's stock with their own money, that's a huge vote of confidence. And if you track institutional holdings, you can see where the big money, the pension funds and hedge funds, are placing their bets. You put all these signals together, and you get a much clearer picture of market sentiment.
But listen, you can do every single thing we've talked about perfectly, and there is still one thing, this silent killer, that can quietly eat away at your returns year after year, and it's something most investors totally ignore. In that killer, it's transaction costs. Yep.
See, monitoring isn't just about your stocks, it's also about your broker. Are all those little fees, spreads, and slippage slowly bleeding your account dry? Being nickeled and dimed over and over again is a massive drag on compounding your wealth over the long term. You've got to do a regular audit.
So as we start to bring all of this together, we land on the golden rule, the one idea that underpins this entire philosophy of smart performance monitoring. I want you to just let this one sink in, because it might be the most important takeaway of all. Your monitoring system is not there to make you trade all the time. Its job is to build your awareness, to strip out the emotion, and to get you ready so you can make a clear, decisive move only when it's absolutely necessary. And that idea of preparation, of discipline over impulse, that's the whole game right there. Because in the end, you don't have to predict the future. You just need a consistent, repeatable process for watching your strategy and making rational decisions. That's what builds real wealth over the long run. It's not a crystal ball. It's a clear, disciplined plan.
Okay. Okay. The most important thing about performance monitoring or performance tracking is that, in fact, we should do it in a planned way without running to around depending on events or big price changes and so on. So you don't plan when you got the stock crashing, or you don't plan when a stock is going sky high. So you have to plan on a consistent basis and on a periodical basis, because only then you can avoid some of the typical traps of portfolio management, like being emotional attached to a stock, using price changes rather than stop loss or profit taking alerts. So basically you need to have to make sure that to have a good performance monitoring, you really have to align your portfolio with your strategy. So that's part of your portfolio monitoring should be also to see how your portfolio is aligned with your strategy. And that's why one needs to compare not just the positions, the individual positions, but also compare using it the way that we monitor the markets that we think are relevant for our exercise. So basically, you have to recall again the tools that we have in our platform that allow you both to compare your stock directly with the market, with the industry, or with the stock peers or competitors. And that's why you should rely on the tools that we provide for performance monitoring, together, of course, with the performance measurement that we'll also have here. So that is also part of the monitor. It's not just looking at our platform, looking at what each individual position is doing, but to look at how the portfolio is performing. So let's go back to our platform and see how we could or how you should use the monitoring in our platform. So basically, it's just not a question. I'm going to use again the stock picks that we have been publishing for the US market. And it's just not a matter of going to the manager section here in the platform. We know already how to use that through the alerts and all the other indicators that we may have here. We can use the dividend and the domicile, industrial, this type of things that we can look at in our monitor. But it's going a little bit more than this. and looking at our evaluation tools. So if you use our evaluation tools, we can start by, for instance, for that portfolio, but I could, if I had other portfolios here, I could also use them as well, but I'm going to concentrate on this one. And the thing to do in a multi-currency portfolio will be to look at the currency. In this case, it's not worthwhile because it's a portfolio for the US only, so it's no point checking the currency, right? At least at this stage. But of course, we have other things to look, like if we look at industry, we have here a problem that is not identifying the industry. Oh, sorry, because I'm using the DTF. Sorry about that. Okay. Okay, so here I can see, look at the industry. And what I can see, it's not only the gains that I have made on the, that we have made on the industry. So you see, you have a loss-making industry here, which is electrical utilities. Otherwise, we have one that is doing extremely well, where we were very fortunate to have this higher return. And so you should look at which sectors are doing well or not in our portfolio, and then we can compare that and go back. If you want to compare with the performance of these industries, we can go to the market section, go to the industries, and see if they really were lucky because we select the right industries, the right stock in the right industry, or we simply are following the trend in the industry. Like I say that if industry here, let's say specialty retailers have the same type of performance, so we're not that clever at selecting the stocks, probably. Okay, so but so you can actually go back here to the market section, to industry, and select retail, whatever it was, retail specialties, was it? Retail. What was it? Retail food? Not was retail. Oh, sorry, I'm not looking in the right section. Sectors, not sectors. Industry, no. Wait a sec. Here. Voilà. Okay, let's see if I can find them here. But no. Please stop by. Okay, sector, not sectors. I'm looking in a different industrial sector. No. Consumer cyclicals, probably. I'm not sure. No. If I can get them here, no, or not. Let's see. No. No. Median filter. I was clicking on the wrong thing. Okay. Median. I want to filter them. The top 20, for instance, by filter. Okay, I think I got it now. Not yet, because I'm getting the sectors instead of the industries. So must be some problem here that I can't work out. But anyway, this should be working. So that's my fault for sure. And why I'm getting this, I really don't know. Do I need to have this? Okay, let's see if I get the top 20, for instance, by medium, and then try to filter those. Maybe I'll get here now the retail, whatever we had in the retail sector. But no, it's not. It wasn't one of the top industries, but I should probably list all of them. Say 153. Okay, and then I can search for retail, specialty retail. Nope. Um, specialty chemicals, mining, retail, retail. Well, I must be some classification problem here because I can't find the one that we were identifying there. Okay, so let's move on because I will have to look at this into more detail, but there must be some problem here. Maybe we're not looking at all of them. Maybe that's probably what's happening. Because it doesn't include everything, apparently. Okay, nope. And let's last try. See the next group. Ooh, ooh, ooh. Okay, I have to check with my people what's happening, why the classifications are not matching the ones here. So let's go to the evaluator section and to my industry. Okay, one thing is in terms of diversification is look at this, but also what we need to look is, of course, we need to make sure that the current weighting of this company, this industry has certainly increased because that's we have the best performance. We have now 8%. Shall we increase this percentage, or is that more than enough? If you look at some of the other industries here, we have some that declined, like semiconductors, some that also declined, like software, and you have the electrical utilities that have been declining. So we have to look at the you look at the industries there, look at their outlook, and see whether we should revise or not our weighting. So this is another way of, and also make sure that we are still very reasonably diversified, and we can make sure here that we are still reasonably diversified because we have 26% as maximum, and we are only including here the top 5 industries because all the others are grouped under others. So the one where we are more greatest exposure is to the semiconductors. So which, if anything, is to need correct in terms of diversification would be in relation to this sector, which we should whose performance we should look at more carefully. Now, if we want to move to the next criteria here, we can also look at their ratings. So let's see how we are doing in terms of our ratings. So most of our stocks are have a rating of average or above average. Some of them have a rating of good, almost 70% they have a rating of good. So in terms of SMR, which is the rating that we use here, we still continue focusing on the top rated companies. So that's part of our assessment. And we have also, if you want, the domicile will be always the US, so no need to look at this. But we can also go and look at return into more detailed. And if we look at the return into more detail, here we can see how our Sorry, I have to open this. Okay, here we have a tool that allows us to assess the money weighted return and the total weighted return in a chart form, as I mentioned to you. So if we want to do that type of analysis, let's just add here, choose here the currency. We choose the dollar, we choose the benchmark, and then we choose the portfolio. In our case, is this portfolio. And let's see what result we have here. So this portfolio is not yet updated until recently, but sorry, let me remove the fees here, and okay. Let's do like that. Oh, sorry, I have to put 0 there. Okay, so let's just check the return on this portfolio versus the market. So what we have here is that on the 27, this portfolio had a market return of sorry, this okay. Okay, let's look at this return. So the portfolio had a return of 40%. So on the 20, so the MWR portfolio was 40%, and the ETF, which in this case would be SPY, would have a return of just 19%. Okay, so we are doing quite well in terms of money weighted return. If I want to look at the the time weighted return, the numbers will be probably much bigger. Okay, would be 35.6, so let's say 35. And sorry, the other way, and 16, actually the other one, 35 is here. And 16, I think, here. And here we have 16%. I think I need a new pen. Doesn't seem to be working, this one. Well, let's do. Okay, we have 16%. Actually, you see this, in this case, is one of those cases where, which happen, but not so common, where the time weighted return is lower than the money weighted return, you see. So this can, and this in this case happens because we invest on both at the same time on the ETF and on our portfolio. So this is, again, the ETF here is the SPY. So let's just see, this would be the SPY. Okay, SPY. But let's imagine that I wanted to compare this with another ETF. let's say, for instance, that I want to compare this with the I don't remember now the code. WCA, maybe? No. I was trying to remember the other index, but I think it's this one. Okay. ACWY. ACWY. Okay. Okay, let's use a broader ETF. This is the world ETF. And then let's calculate the return now. And here this would be still the same. The ETF would be 24. So if I was going to compare with what's the code? Sorry, ACWY. Then the performance would be just 24%. This would be so it would be so if I use a different benchmark, you see my return would be so good if you compared with a different benchmark as it would be if I compared with the US market. Now let me make another change, which is comparing in a different currency. Let's put SPY here. Oops. And let's check the performance into FI, for example. Performance would be, so this is in US dollars. But if I want to do it in FI, then this would be just 38. And the other one would be 17. So basically I would be comparing 38 with 17%. So it's already a different number. And if I want to compare again in relation to the CWI, would still be a different number. So we have we can easily measure here the impact of currency changes. Now the other thing that I wanted to draw your attention is, of course, the possibility of paying fees or your management fees, or changing the tax that we are assuming here, which is a 50% capital gains tax. But if you want to put a 30% capital gains tax, then you would also can you also check the results like that. So basically, in this platform, we have you have the possibility of measuring your performance against whatever index you want by selecting here the index you want and using whatever currency you want. So if I go back to the USD, okay, so this would be the typical measurement in the US for a US investor, but for an outside investor, it will be using probably a different currency or using even a different ETF. Let's say, for instance, I'm a European, so I want to invest in Germany, for instance. I'm a German investor. Then I want to know the return in euros, and I want to compare it not with the SPY but with the DEX. And so I'm going to compare with this way, and then I would have, this will be the measure that interests me. So I would see that the return would be 30% against 11%. If I were to measure it in So I would be measuring 30% against 11%. So my performance would be even better. If I were a German investor in the US, then my performance would be much better. The other important thing to retain, as I was already mentioned several times, is that here I can actually see how it is evolving a long time. We should not go too much back on this. It starts on October, so it's just the last 6 months. But you see, gives us a trend where how this measure has been evolved in the last few months, and you see that it has been relatively stable. The difference between the two alternative investment in the portfolio or into a benchmark. Okay, so this is a tool that will come back again a little bit later on. But I think let's make a kind of summary right now. So first thing is we need to check, or we can check on a frequent basis, basically just the change in the net asset value. So how much money is our portfolio worth, and how much have we invested, which I come here. Basically, I look into so we invested 3,104,000. It's now worth 3,800,000. So this is the measure that I want to know. So how much I'm making? 700,000. Okay, that's one measure. This corresponds to, in terms of just value change, it will be an increase of 22.7%. So this is the kind of so that's the first and the usual monitoring that one needs to do. So it's basically monitoring one needs to do. So, but from time to time, I should go to the next section. Of course, I can do it every day, but it will be a bit time confusing and especially time demanding. It's really not that worthwhile. But from time to time, let's say at the end of the month or at the end of the quarter, I go down to the evaluator section, and then I look at the various determinants of the evolution of my portfolio, because it's based on those that I will have to conduct my future management of the platform, of the portfolio. Sorry. So these are the basics of performance measurement, and there is some more that we have here on this evaluator section that we'll just mention them briefly in the next discussion.